We already know that the Federal Reserve is going to increase interest rates in order to fight inflation, which is still the number one risk financial markets in the US are facing. And it's not even a US thing, it's a global thing. And I've been sharing with you many times, following closely what the Federal Reserve, speech, testimonies, comments around what they will be doing. All right. So the market reacted so far in a positive way, kind of shrugging off and brushing off all of the comments and the game plan the Federal Reserve mentioned a couple of weeks now. We already know that there's going to be 7 interest rate hikes. So the market is kind of fine with it as long as it's gradual. But people are not knowing exactly. People are kind of in the dark about, hey, what if there is a brutal change? What if in the second meeting or the third meeting, instead of just going along with what they planned because of something changing in the economy, sustaining that inflation is going to be a lot more higher than we expect it to be at that period of time, then what if we jump to 1%? Then it will cause a catastrophic chain effect, catastrophic domino effect into not only the institutional investors, but also how the markets will react to this. And this is something that ultimately should act as a good catalyst. All right. So I know many times we talked about this, but let me just bring forward what the the founder, Thomas Peterffy from Energy Brokers mentioned about this, and it will definitely give you another insight from somebody else who have been in the market for quite some time now about what you may expect if we get those brutal interest rate increase, which, by the way, it's not totally off the table. All right. So let me share with you quickly what I'm talking about here.
And this situation is further aggravated by the very high level of borrowings in the $11 trillion private equity space, where managers have been trading companies among each other at ever higher prices, loaded with more and more debt. That worked just fine with, well, interest rates were zero, but they will not work at 3 to 5%. So I think we'll see a lot of bankruptcies in this space. Well,
A lot of bankruptcies in this space, a lot of bankruptcies. So bankruptcies for institutional investors, we've been using a lot of debt because they were under the impression that, hey, when you look at the math only, it makes sense to use ton of debt to invest or to trade or to do whatever in order to put your money to work. But you are not using your own money, you're using somebody else's money, you're using the house money. And it's fine as long as you don't have to pay that much in terms of interest rates in order to keep using that money that's been provided by the house. In this case, the house is the Federal Reserve, the central bank. But now they cannot afford to do that anymore. And by they, I mean both the central bank and those investors, those banks, those big short sellers, those companies that might be involved here in this play as short sellers. Because even though it will not directly impact those who are, even though some of these companies that are not in AMC or in these other meme stock short play, well, they will still be impacted at some point. Why? Because as a liquidity provider, I will be more reluctant to give you the same amount of margin, the same amount of cushion that I gave you 12 months ago, or even 6 months ago, or even 3 months ago, because it doesn't make sense anymore, especially if I'm already losing a ton of money based on what is happening in China with Evergrande and in Russia with this whole thing. All right. Plus the sanctions. The sanctions on Russia, it's definitely creating a chaos on global trade business. Now, on the other hand, if you are short selling a stock like AMC, all right, and you have a bunch of a big position, and so far you are using to actually balancing your losses, with the gains you were having into companies like maybe Tesla or Neo or Amazon or Apple, all right? Well, if the market and since the market kind of, went down, now it's recovering a little bit, but when these companies, when these stocks that you're holding are also depreciating, you're losing value of your entire, balance. As a consequence, in the case of that money that you used to pay as interest rate on your debt is getting tighter and more higher, well, especially if it's a brutal event, then, as Mr. Peterffy say, you are looking at, a dangerous position. And even if you try to reduce and mitigate your losses, the first thing you will do is not to take out your profitable positions, right? Is to actually get out of your most risky positions where you're using the more money, when you're losing money the most, and that will be your AMCs and your GameStop. That is what I will do, and I will think as a short seller, because it's what makes sense if you want to still be in business. All right. So just to say that when we say that the moon is getting closer and closer, it's not because we don't see that translated into the share price that it means it's not possible. Because again, the conditions are getting tighter and even more stretched for those in the wrong side of trades here, especially in AMC. So watch out, folks.